once again, thank you for all the participants for taking out time to attend the session. So what we would be discussing is, more of basics of Canadian personal taxation. Of course, we have certain limitations of time, so we would be touching a lot of these concepts on a high level basis, and we would try to kind of carve out a short span of time for any questions that any of the participants may have. What I would request is, if you have any questions, you can try to put it in the chat box, and after the entire presentation is gone through, we would try to see as many queries we can resolve during the course of the session. So starting with Canadian personal taxation, a lot of our participants are, let's say, recent immigrants to Canada, trying to find their foothold in the country, trying to understand complexities of taxation, and tax being a major revenue source for the government. And also, it's a major discussion points for, financial planning or budgeting. It's very important that individuals have a basic understanding of how taxation works. That goes a long way in helping them plan their finances, creating those strategies which optimize the overall tax liability, minimize it in within the legal framework, and helps in a lot of cash savings. So to start with the tax implications for an individual in Canada, it is very important to understand what is the individual's Canadian tax residency, because that's the starting point for determining what source of income is taxable for an individual in Canada. So if an individual is a Canadian tax resident, he or she shall be liable to be taxed in Canada in respect of their worldwide income. So what does that mean? It means that the individual is taxable not only with respect to incomes that the person earns in Canada, but also with respect to any income that the individual earns outside of Canada. So let's say, a person is a Canadian tax resident and has salary income in Canada. At the same time, they have investments in India, in shares, mutual funds, or rental income from properties in India. So those incomes will also be taxable in Canada. But if you are a non-resident of Canada, as per the residency laws, then you are taxable only in respect of incomes that you earn in Canada, which means that you would be taxable only with respect to your salary income or interest or investment income in Canada. But any income that you earn outside of Canada will not be subject to tax. Now, the main moot point is, how do you determine residency status in Canada? So, different countries have different rules and regulations in determining the tax residency. So, if you talk about India, you kind of follow the number of days of presence rule, which means that if you are a resident in Canada for India for X number of days, then you attain Indian residency. But in Canada, the number of days of stay is not the primary rule. What depends is where are your primary residential ties? That is, what is your intent while coming to Canada? Is whether you are coming to Canada for a long-term residency purpose, that is with an intent to immigrate to the country. Will your family also move with you in Canada? And after your arrival in Canada, are you going to earn your major source of income in Canada? So to give you an example, let's say, a family arrives, let's say a husband and wife with two children. They have obtained their Canadian permanent residency, and they have decided to start their life afresh in Canada. They book a flight and arrive in Canada on 1st April 2024. Their intent is now to kind of find schooling for their children in the country, in the near future, buy a home, find jobs to sustain themselves in the country, and also to plan the long term future. In that situation, the person or the entire unit, that is the spouse and their children, will become Canadian tax resident from the day of their arrival in Canada. So they become Canadian tax resident from 1st April onwards. Now, coming back to what is the fiscal year in Canada? So in India, the fiscal year runs from 1st April to 31st March. But in Canada, it runs from 1st Jan to 31st December. So your tax year coincides with the calendar year for an individual. So based on, let's say, your arrival in Canada, you kind of start your Canadian tax residency. So let's say you arrive in Canada for part of the year. So for example, for the period from 1st Jan to 31st December, You arrive in Canada with your family with the intent of living in Canada for the foreseeable future from 1st September. So you become a Canadian tax resident from 1st September to 31st December. So that is called as a part year arriving resident. Similarly, in the future, you decide to leave Canada permanently. uh, you want to go back to India, or you find a better opportunity somewhere else, and now you want to, wrap up your, rental agreement, sell your house, end the school admissions or gym membership admissions in Canada, and book a flight to return back to your home country, or let's say to the US or any other country. So as on that day, you cease to be a Canadian tax resident because your intent to live in Canada ceases on the day you decide to move out of the country. So in that situation, you become a part-year departing resident. On the other hand, if you are living in Canada for the entire calendar year, that is someone who arrived in the previous year, and let's say for the 2024 tax year, they are, living in Canada for the entire period from 1st Jan to 31st December, then you are a full year tax resident. Now, coming on to what are the primary and secondary residential ties which determine your residency. So, the CRA, which is the Canadian Revenue Agency, has prescribed certain guidelines which have to be analyzed to determine whether you become a part year arriving resident, or full year resident, or a part year departing resident. So residential ties are split into primary residential ties and secondary ties. So primary ties is where is your location or your dwelling place going to be after you arrive in Canada? That is, are you going to pick up a house for the long term? I mean, whether you're going to sign a long-term lease or you're going to buy a house after you arrive in Canada, whether your spouse or children will also live with you after you arrive in Canada, and whether you're going to earn significant portion of your income post your arrival. Ties, there are also certain secondary ties to be evaluated, but those are to be evaluated only if there is a conflict between primary ties. So let's say you have a house in India as well as in Canada. Uh, your family is split. Let's say your spouse is in Canada, but your children are currently in India, or vice versa. And there is no determinant factor on where your primary ties reside. In that situation, you also analyze the secondary residential ties, which would mean, what is going to be your immigration status when you arrive in Canada. Do you have medical insurance coverage in Canada? Do you have a driving license, memberships in Canadian unions or professional organizations? And where are your primary social and economic ties going to be after you arrive in Canada? So based on the evaluation of your primary and secondary residential ties, your residency is split into four categories. One is the deemed resident category, or a situation where you are resident in Canada for whole part of the year. At the same time, if you are working in the consulate office of Canada and you're a government official who is deputed outside of the country to any other consulate, that is basically Canadian government officials, they would also be deemed to be tax resident of Canada and would be taxable to subject to worldwide taxation in Canada. At the same time, giving an example of a family or an individual arriving in Canada for part of the year, their residency starts from the day they arrive in Canada. So in that situation, you are taxable on global income only from the day you arrive in Canada. But any incomes that you earn outside of Canada before your arrival, that will not be subject to tax in Canada. So taking that example of the family who arrived in Canada on 1st September 24, they will be subject to global taxation from 1st September to 31st December. But any incomes that they earn from 1st Jan to 31st August, which is earned outside of Canada, that will not be subject to Canadian taxation. For a non-resident, you are taxable only on Canadian sourced income. And similarly, if you're a deemed non-resident, that is, you have, let's say, tax residency of India and you're a tax resident of Canada at the same time, and based on the evaluation of the tax treaties, it is determined that you are a non-resident of Canada, then you would be subject to Canadian taxation on Canadian sourced income only. So in Canada, you are taxed on progressive tax rates. That is very similar to Indian tax rates, which is on a slab rate basis. So higher your income, higher is the tax liability. And there are two levels of taxation in Canada. One is the federal level and the other is the provincial level. So you are subject to the federal and provincial taxes. The provincial taxes may vary based on the location where you're residing, and your residency as on the year end is extremely important to decide which provincial tax rates would be applicable to you. So let's say, you are living in Calgary for a major part of the year. Let's say after the year you were living in Calgary for 9 months, and then you decided to move to Toronto. And as on 31st December 2024, you are living in Toronto. So when you file your return, one of the questions that is asked is in which province were you residing as on 31st December? So based on that location, you would be subject to Ontario provincial taxes and not Alberta provincial taxes, because your residency as on the year end was in Ontario. Uh, I've just provided a brief tab for the tax rates and tax brackets for the 2024 tax year. These rates are purely federal rates. The provincial rates may vary, and you can look up to the Canadian Revenue Agency website for the provincial rates based on the location of your province. So as you can see in the tax rates, up to 55,867 worth of taxable income, you would be subject to 15% tax. From 55,000 to 112,000 dollars of taxable income, you would be subject to 20.5. If your income increases up to 173,000, you would be subject to 26%. At 29% up to 246,000, and at 33, rates are purely federal rates. Let's say if you are earning taxable income in excess of 246,000, you would be subject, in Ontario, you would be subject to a 53.5 combined federal and provincial tax rate, which is the highest tax rate based on your income levels. It is also very important to note that in Canada, each individual has to file the tax return separately. And this is very important, particularly for people who move from the US, because in US, there is a concept of joint filing of tax return. So the husband and wife can file returns as a combined unit and report both the incomes together in one tax return and get the benefits of married filed MFJ return or married filed jointly return. But in Canada, there is no concept of joint filing of tax return, which means that yourself and your spouse have to file your returns separately, and you would be entitled to individual tax deductions, credits, and tax rates.
I'm so sorry for interrupting between this. So there was a question from Preetham. Shall we take question now, or shall we keep it for the end?
What I would recommend is we can run through the questions quickly at the end, so
Okay,
we would
done.
have enough time. Else we may not be able to complete the presentation in the hour. Yeah.
Okay.
Thank
Okay,
you.
done.
Thank you so much. Yeah. Thank you for your patience, Prino. Yeah. So coming on to the filing deadline. So the due date of filing the Canadian individual tax return is 30th April of the subsequent year. That is, if you're filing tax return for the calendar year 2024, your deadline would be 30th April 2025. So there is no extension available. Unlike in US, you get a 6-month extension to file your tax return. But in Canada, returns have to be filed by 30th April. And if you have any tax owing, you would be subject to interest and penalties for late filing of taxes. Once the return is filed, the CRA usually takes around 2 weeks to assess your return and issue a notice of assessment. But before they issue a final notice of assessment, they also issue an express notice of assessment on the online portal. So the express notice of assessment is issued within 7 days of filing your tax return online. And if there is any refund due to you, that will be credited into your bank account. If there are more complexities in your tax return and there are more deductions or credits claimed, which cannot be assessed directly by the CRA through their computer assisted systems, then you might experience there is a more delay in the processing of your notice of assessment. And in case if you haven't received your notice of assessment within the 2-week time frame, you can always contact the Canadian Revenue Agency at their toll-free number to inquire the status of your tax return. So the notice of assessment is an extremely important document. It is basically, let's say, kind of a certificate of assessment by the CRA, where either they accept the return that you have filed, or if they find any discrepancies, they'll make those rectifications and provide you with the final outcome. The notice of assessment also has details of what is your RRSP contribution room, your FHSA room. If you have tuition credits, it will provide the amount of your tuition credits carry forwards and also your capital loss carry forwards, if any. So whenever you start your tax return and if you have filed Canadian returns in the past, it's very important to keep the copy of your previous year's notice of assessment, as that will provide you with the information that you need to file your current year tax return. As per law, you need to retain notice of assessment for 7 years. But now, since all of these notices are issued electronically, you can always retrieve any of your past notice of assessments on the CRA portal. If you are entitled to a tax refund, the Canadian Revenue Agency would either issue a physical check at the address which you mentioned in your return, or if you have updated your direct deposit details on your Canadian bank account on file, your refund will be credited directly into your bank account. It is always advisable that once you obtain access to the CRA online portal, you should update your bank details, because there are many cases where people move the addresses or change their homes and the refund checks are issued at the previous address where they cannot retrieve mail. So that can cause a lot of inconvenience in reclaiming your refunds. Now coming on to what are the various types of incomes that are taxable in Canada and what are the tax treatments of the income. So starting with employment income. So the rules under the ITA state that employment income includes all kind of payments that you receive from your employer under the employer-employee relationship. So that would include your base salary, your bonuses, if you received commissions or gratuities or tips based on the nature of your employment. All of those amounts would be subject to tax in Canada as employment income. Your employment income would also include, let's say, director fees, if those fees are paid to you as part of your employer-employee relationship. So similar to India, where you used to receive a Form 16 after which was provided by the employer, which had details of your gross salary, your tax deductions, and your TDS which is deducted. A similar form is also existing in Canada, and the name of the form is T4. So this statement of remuneration, or T4, is issued to you by your employer after the end of the year. So after the end of the fiscal year, the employer files the T4 with the CRA by the end of Feb. And generally by first week of March or mid-March, they issue the tax slips to the employees based on the respective employee portals. And this T4 is also filed with the CRA under your SIN number. So what happens is that the CRA already has a record of your salary income. So if you're filing the return and you make any errors or you miss reporting your salary income from your T4 slip issued by the employer, the CRA would be able to detect the amount of income that you have missed reporting and would update your return by issuing a notice of reassessment or a notice of reassessment and rectify your missed incomes. So the T4 would have details of all your salary that has been received by you, and also the social security deductions, which is deduct contributions towards CPP, EI. If you're making contributions to the company RRSP, it will have your portion of contributions reported. And if you're receiving any non-cash benefits, those will also be reported in designated boxes of the tax slip. So this is a sample of the T4 slip. So as you can see, there are boxes for different kind of income, and there is numbers associated to different boxes. So what these numbers certainly help is, let's say if you do not have understanding of how you need to file your return, and you're filing the return for the first time, and you do not know where you need to report these in numbers provided in the boxes in your tax return, all you need to do is follow these box numbers. So if say something mentioned in box 14, your online tax return tool will also have a similar box, and you just need to replicate this particular T4 into that return. Each box has an explanation of the kind of income or the kind of contributions that have been reported therein. So here you can see is a list of the various boxes and the explanations to that. So for example, box 10 provides details of province of employment, box 14 provides information of what is the gross salary that is paid to you. Box 16 has details of the CPP contribution that has been made by during the year. Box 18 has details of EI contributions. Box 22 will have details of what is the total income tax, which is federal and provincial tax deducted. 24 would have your gross EI earnings, and box 40 generally has all the non-cash benefits that are paid to you. So if you have any, you're participating in the company health plan, if there are any reimbursement of expenses or any other perquisites that are provided in addition to your salary, that will be reported in box 40. Now coming on to investment income in Canada. So investment income would generally include, incomes from interest, from savings account or deposits in Canada, and also include, interest from your fixed deposits in India. If you have made, earning any rental incomes or receiving any, dividends from investments in Canada or India, all those would be considered to be investment income. A very important point to note is that most of non-residents or Indian NRIs do have fixed deposits in India, and they redesignate their accounts as NRE accounts in India, where they deposit money and earn tax-free interest income in India. So NRE interest is not taxable in India as per the Indian tax laws, but in Canada there is no distinguishment between interest income earned from NRE and NRO account. So if your NRE FD interest is tax-free in India, it will be subject to tax in Canada if you are a Canadian tax resident. So you would still have to discharge your tax liability in Canada, specifically for NRE FD interest. Against your interest income, you're allowed to claim deductions for management fees and investment loans. So let's say if you've taken a particular investment loan to earn investment income, then you're allowed to claim deduction of that loan interest against that income. Similarly, if you have, appointed an asset manager or financial planner to manage your investments, and they do charge some management fees, you are allowed to claim deductions in Schedule 4 as part of your tax return. So investment incomes would not only include, interest incomes, but would also include capital gains that you earn from investments made whether in India or Canada. So in Canada, there is no concept of short-term or long-term gains. So if you have been a regular investor in shares or mutual funds in Indian equities in the past, you may be aware that in India, there is a distinguishment between short-term and long-term capital gains. That means any shares or mutual funds sold within 12 months is considered to be short-term, whereas any shares, mutual funds, or securities sold after 1 year is considered to be long-term. And there are different tax rates in India based on the period of holding. There is a similar principle in US as well, where the tax rates are different based on the term of holding of your investments. But in Canada, there is no concept of short-term and long-term. But Canada follows the income inclusion method of taxing capital gains. So in Canada, 50% of your capital gains is taxable. So let's say if you purchased a share of, $100 and you sold it for $200. So you earned a gain of $100. So 50% of that gain, that is $50, would be considered to be your taxable capital gains. And it would be subject to tax at the same rate at which you're taxed on other income. So if your tax rate is, let's say, 30%, so you pay 30% of $50, that is $15 as your capital gains tax for the sale of investments. However, there has been a certain change in the income inclusion rate after 25th of June. So previously, any gains that you earned before 25th of June 2024, you are subject to 50% inclusion. That is, only 50% of the gains was taxable. But after 25th of June, 66.67, that is two-thirds of your gain is taxable for individuals, provided the gains are in excess of $250,000. So if you're planning to sell any, investments after 25th of June 2024, and if the gains are going to be more than $250,000 for an individual, so you would be subject to two-thirds inclusion, which is you would be subject to higher capital gains tax rather than for any gains that you sold before 25th of June. Another important point to note is that, especially for shares and securities, in India, generally, when you sell shares, to determine what is your cost of the shares that you purchased, you generally follow FIFO method, which is first in, first out. So if you bought some share at 2014 of Reliance and you continuously bought shares over a period of 8, 9 years, and you decided to sell a part of the shares in 2024, so if you're calculating capital gains tax in India, you would first pick up the purchase cost of the shares that you purchased at the first time. That is, let's say in 2014. But in Canada, there is no FIFO method to be followed. You follow the average cost base. So basically, what you do is you take the value of the total purchase cost and divide it by the number of shares you hold to decide the average cost base. So it is different than the India and US FIFO method. It's a more convenient method, but at the same time, it kind of averages out your cost across all your shares of the same class. With respect to capital losses, uh, since 50% of your cap gains is taxable, or 66.67 based on the date of your sale, if you incur capital losses, similarly, only 50% of your capital loss, or one third, that is 33% of your loss after sale of 25th June, will be allowable capital loss. And these losses are first set off against any other gains that you earn, that is capital gains that you earn on any other sale of assets. After that, if you still have some excess losses, you're allowed to carry it forward indefinitely, or you can carry back those losses to 3 prior years. So let's say if you have filed tax returns in 2022, 23, and you had some capital gains, but in 24 you had significant capital loss, you can go back to your old returns, use those losses to reduce your capital gains and claim refunds, provided your 2022 and 23 tax returns were filed on or before 30th April. If you have been delinquent in filing a previous 3 years return, then you cannot claim carry back of your losses. At the same time, if you anticipate, gains in the future, you're allowed to carry forward the capital losses to future years. And the details of your capital losses are generally provided in your notice of assessment. So that's why your notice of assessment and your balance details on the online CRA account are very important to decide how much of losses can be carried back or carried forward. Now, coming on to taxation of investments at the time of arrival and departure in Canada. So I would go back to the main point for Canadian residency. That is, at the time when you arrive in Canada with the intent of living in Canada for the long term, you become a Canadian tax resident from the date of your arrival. So as on that day, the cost of any assets that you owned, let's say in India or in Canada, the cost of those assets for Canadian tax purposes shall become the fair market value of those assets as on the day you arrive in Canada. Now, what does that mean? So going back to that family example, which I was discussing previously, let's say the family has arrived in Canada as on 1st September 2024, and they had certain investments in mutual funds in the past when they were working in India. And the value, the amount that they had invested in the past, let's say in 2020, they decided to invest in mutual funds in India and they bought those mutual funds for 10 lakh rupees. And as on 1st September 2024, the fair market value of those investments is 25 lakh rupees. So for Canadian tax purposes, the cost of those investments shall not be 10 lakhs, which was actually paid, but 25 lakhs, which is the fair market value as on 1st September. So fair market valuation also applies in case of your home in India. So let's say you had purchased a home for 50 lakh rupees and you decided to come to Canada on 1st September, and the market value of that home now is 75 lakhs. So in the future, after you arrive in Canada and within a year of your residing in Canada, you decide to sell your Indian house to get cash for investing or purchasing a home in Canada. So when you're computing your capital gains, your let's say your sale value was 1 crore, your purchase cost for that house will be 75 lakhs and not 50 lakhs, which you actually paid to purchase the house. So it's very important to keep record of the fair market value of your assets as on the date of your arrival. For shares and securities traded on listed exchanges, it is very easy to get that information because historical data is easily available. For properties or land, there's always a very tricky situation of how you decide the fair market value as on your date of arrival. So one way is you can obtain a few realtor reports from publicly available sources, or you can get your valuation of your assets, real estate assets, from a registered valuer in India, so that in the future when you actually sell those assets and compute your capital gains, and in case if your tax return is picked up for audit, your fair market valuation basis can act as sufficient proof to the CRA while they assess your capital gains. Similarly, when you decide to leave Canada for good in the future, let's say an individual has found a great up in the US or UK, and they've decided to leave Canada, wrap up their ties and take the flight out of the country. In that situation, there is a deemed sale of all the assets that you owned in Canada or outside Canada on the day of your departure. This is also known as departure taxes. What it means is that you don't actually need to sell all your assets, whatever you have accumulated while you leave Canada, but for taxation purposes, there will be a deemed sale, which means at the fair market value on the day you leave Canada, those assets or designated class of assets will be assumed to be sold, and you need to compute your capital gains and pay departure taxes if applicable and report it in a specific form, that is T1243 and T1244, which are the prescribed forms in the tax return to report your departure taxes. It is important to note that any investments in registered accounts, which is RRSP, TFSA, RESPs, and the like, those are exempt from departure taxes. At the same time, if you decided in Canada for less than 60 months out of 120 months, which means, for example, a person arrived in Canada in 2020 and has now got an opportunity outside of Canada and wants to leave the country in 2024, in that situation, the person has resided in Canada for less than 5. In that situation, if the person has any assets which he owned, let's say in India, before arriving in Canada, that is before 2020, those assets would not be subject to departure taxes. So if you have lived for less than 60 months, there are certain exemptions for non-Canadian assets which are exempt from departure taxes. But if you are residing in Canada for more than 60 months and you're the country, you would be subject to departure taxes on all your assets. Yep. So this slide again, talks about the adjusted cost base of investments, very similar to what we discussed previously. Now, quickly coming on to rental incomes. So a lot of people, do make investment property purchases in Canada and on rental incomes. So your rental income has to be reported as taxable income in Canada, irrespective whether your property is in Canada or in India, if you're a Canadian tax resident. But unlike in India, you get a deduction of only 30% of your expenses under the house property rules. But in Canada, you have more scope for deducting expenses. So you can claim deduction of the interest component of your mortgage against your rental income. You can also claim deductions for management fees, condo fees, property taxes, agent fees, and also if you're paying any utilities or parking expenses on behalf of your tenant, all of those can be claimed as a deduction. If you have made any purchases of, let's say refrigerator or equipments or appliances which have utility for more than 1 year, you can claim depreciation, which is also known as CCA or capital cost allowance, against your rental income. It is important to note that if you're claiming CCA or depreciation, you cannot generate any rental loss. So let's say if your rental income is $1,000, your expenses $500. So your net rental income is 500, and you have made some capital expenses on upgrading your basement or your house and are entitled to claim depreciation. Your depreciation would be limited to $500 only, so that your rental income becomes zero. But if you have paid cash expenses and incurred a loss, your rental loss is allowed to be set off against any other income, and that would reduce your overall taxable income and increase the chances of claiming refunds, if any. Uh, Now coming on to what are the permittable, reasonable rental income and expenses. So there are two types of expenses. One is the current or operating expenses, and the other is capital expenses. So current expense would include repairs and maintenance, property taxes, mortgage interest expenses, and the like. And the other expenses, which are of long-term enduring nature, would be capital expenses. And so capital expenses, as I said, if you're upgrading your house, making renovations which will result in higher rental income in the future years, or upgrading your appliances, you would have to capitalize. So you cannot claim a tax deduction, but you need to capitalize it and claim depreciation over a period of years. Now, quickly moving on to business income. So if you are undertaking any business activity, which includes any activity intended to earn profits, that is considered to be business. So even if you're doing, sale of any, getting some goods from India, or doing, some hobby sales, or, teaching some students and earning some side income, that is considered to be in the nature of profession or trade and is to be considered to be business income. The advantage of business income against salary income is that there is wide range of deduction available. So you could claim deductions of all the expenses that you incur to earn the business income. So let's say if an individual is a realtor and earning commissions on sale of property, and if they're incurring expenses for travel, showcasing, maintaining their offices, obtaining the realtor license and the like, they can claim all those expenses which are incurred for earning those business income. So, unlike salaried income, where taxes are deducted by the employer and reported in T4, business individuals have to, report their incomes and pay taxes on their own on a quarterly basis. For individuals, the calendar year will be the tax year, and they would have to pay, installments on a quarterly basis, which is due on 15th March, 15th June, 15th September, and 15th December. For a individual having business income, the deadline of filing the tax return is June 15th and not April 30th. Similarly, if any of your spouse has business income, the deadline of yourself and your spouse moves to June 15th and not April 30th. So if you have some business income, you don't need to worry about the April 30th deadline, because you get time till June 15th to file your return. Business income has to be reported in the form 2125, which is designated form where you report the income and expenses. And this is a list of all the possible expenses that you can claim. If you're incurring expenses for advertising, legal expenses, rent, maintenance, insurance, business taxes. For any meals and entertainment, you get deduction of the expense. So if you're taking out clients for some meals, only half of those expenses are allowed as a deduction. Now, quickly moving on to tax deductions. So any payments that you make for membership fees for unions, that is, if you are a CPA member of CPA board and you're paying annual membership dues, or you're paying ICA membership fees, you are allowed to claim deductions for those memberships. So even if you are a member of ACCA or CBV board or any other agencies, you are entitled to a deduction for that. Similarly, if you are moving between provinces on account of your job. So for example, let's say you're living in Toronto and your company has moved to Vancouver, or they've decided to relocate you to Vancouver to be closer to the Vancouver office. In that case, all the expenses that you incur, that is, terminating your lease agreement or selling your house, the cost of meals or residing on a temporary accommodation before you find a new place in Vancouver, all of those expenses are allowed as a deduction for moving expenses. It is very important to note that if you are moving from India to Canada for a job purpose, that is not considered to be moving expenses. The move has to be within Canada. And similarly, if you kind of moved without a job and you had incurred such similar expenses, those are not allowed as a deduction as moving expenses. You're also entitled to claim deductions for childcare expenses. So for childcare, you allow deduction based on the actual expense incurred, which is, the receipt that you receive from your daycare. At the same time, if you have enrolled your kids in summer camps or hobby classes, you are entitled to claim deductions, provided you receive, invoices or receipts for those expenses. For childcare expenses, they can be claimed in the tax return of the individual having over income. So basically, if you and your spouse are earning income and your spouse is earning lower income, you can claim deductions for the spouse with lower income would be able to claim deductions for childcare expense. So the cap amount for childcare is generally 2/3 of the earned income, or 8,000 for each child for 7 years, 5,000 when the child is aged between 7 to 16, and or an additional 5,000 for children over the age of 15 who has any physical or mental infirmity. Now moving on to non-refundable credits. So what does non-refundable credits mean? There's always a confusion as to what is a tax deduction and what is a non-refundable credit. So tax deduction means any payments you made are allowed as an expense deduction against taxable income. But for non-refundable credits, you do not get any tax deduction against taxable income, but you get a reduction in your tax liability. So generally, the amounts which are entitled to non-refundable credits, 15% of that amount is allowed as a reduction or a credit against your tax liability. So it reduces your tax liability, but this does not reduce your taxable income. And as the term states non-refundable, it means that you cannot receive a tax refund purely on account of your credits. So if your credits are more than your tax liability will become zero, and the balance credits, if allowable, will be carried forward in the future years. But in no situation you would have a situation where you are earning refunds from non-refundable credits. So you get a basic personal amount credit, which is 15,705 as per 2024 amount. And if you are in Canada for part of the year, this amount is prorated over a number of days. You also get a similar amount for your spouse if your spouse is not earning income up to $15,000. If she earns more than $15,000, you do not get this spouse credit. For individuals more than 65 years old, they get another credit of $8,000. For any contributions you make to CPP and EI, you are entitled to these contributions. You also get a nominal contribution, 1433 of non-refundable eligible credits for being employed. For tuition, so specifically for students who are studying in Canada and incurring tuition fees, you are entitled to claim tax credit up to 15% of your eligible tuition fees, for which your education institution shall issue a T2202 at the end of the year, which is a tuition credit slip. And it's very important to keep records of that. So because that will help to minimize your tax liability in the years, as long as you have available tuition credits. If you incur any medical expenses which are unreimbursed, that is not covered under your insurance coverage by your company, and the amount of those expenses, that is towards dental care or healthcare, exceeds $2,759, you also get an additional 3% of tax credit for that. Any donations you make for registered charities, you get a 15% federal non-refundable tax credit. So this rule encourages people to make donations to registered charities. Any contributions you make to your affiliated trusts which are registered and they issue a donation slip, you can get money back from the CRA by way of tax credits. Now quickly moving on to pensions in Canada. So there is a registered retirement savings scheme in Canada which is very similar to a 401k plan. So any contributions that you make in this plan, you are entitled to a tax deduction. And in the future, when you make withdrawals from the plan, you are entitled, the withdrawals will be subject to tax. So it is deductible when you contribute, but taxable when you withdraw. And you can only make contributions to the plan to the extent of the contribution room available to you. So this contribution room is decided based on 18% of the previous year's income and or the limit prescribed by the CRA, whichever is lower. So the maximum contribution, let's say for calendar year 2024, could be around 31,560. You can make withdrawals from your RRSP for purchasing your first home up to $35,000 of amount invested, and that withdrawal would be tax free. Similarly, if you want to pay amounts for education, you can withdraw up to $10,000 from RRSP towards lifelong learning plan. So withdrawals, as I said, under a home buyer's plan is allowed tax free up to $35,000, subject to certain prescribed conditions. That is, that amount has to be paid over a period of 15 years by way of contributions back to the RRSP. Similarly, you can withdraw up to $20,000, but subject to 10,000 annual limit for any education under the lifelong learning plan, and you would not be subject to tax on the withdrawal. There is also another registered account, which is a tax-free savings account. So the difference between RRSP and tax-free is that contributions to tax-free savings account, you do not get any tax deductions, but any income that you earn in the tax-free savings account, it is non-taxable. So there is no deduction when you contribute, but no taxation when you withdraw. There are prescribed limits annually under the TFSA. So for 2024, the maximum contributions that you can make is $7,000. It is very important to note that the RRSP and TFSA rooms are cumulative. That is, if you have not made contributions in a particular year, your unused balance is carried forward and it accumulates over a period of years. So that allows you sufficient planning. Let's say in the years where you have higher income and you have sufficient contribution room, you can make contributions to your RRSP and claim tax deductions, or make contributions to your TFSA to earn tax-free income. There is also a particular scheme which is registered education savings plan, and this plan allows you to save for your children's education. The lifetime contribution can be made is up to $50,000, and annual contributions can be made, up to $2,500, for which you get a 20% grant. So for every $2,500 that you make in the plan, you get $500 from the government, up to a maximum of $7,500. So, one way of effective strategy is that, you could make a lump sum contribution in the first year, and for the subsequent years, you could make contributions up to $2,500. Since for every $2,500 you make contributions, you get a $500 grant from the government, which adds back to your plan, and you can make investments based on your risk appetite to kind of compound the value, so that once your child is ready or of age to avail higher education, that you can make withdrawals from the RESP, and any withdrawals that you make are taxable in the hands of your child. So let's say when your child is around 18 years of age or is going to university, they may not have sufficient income, so any withdrawals you make will be taxed basically at very low rates in the hands of your child. There is also a first time home savers account, which was announced very recently by the government, and you can make a contribution of $8,000 annually up to a lifetime contribution of $40,000. So contributions that you make to this account is also allowed as a tax deduction. So apart from RRSP, the FHSA allows for additional room. The advantage of FHSA is that when you withdraw it for buying a home, you're not subject to tax. And let's say after 15 years, you decide not to buy a house or use your FHSA amount to buy a home, you can transfer the FHSA balance to your RRSP on a tax-free rollover basis. Now coming on to another important aspect, which is foreign asset reporting. So Canadian residents, as I said, are required to, subject to tax on worldwide income. At the same time, they would also have to report their assets outside of Canada in a designated form, which is the foreign asset reporting or FAR form. This particular form is also known as T1135 in the tax return. For the first year of your arrival in Canada, you're not subject to foreign asset reporting. But for any subsequent years, you may be subject to foreign asset reporting if the cost of your foreign assets is more than 100,000 Canadian dollars. So if your value of your investments in India, let's say the value of your house, or the value of your stocks, shares, gold, artifacts, and the like is more than $100,000, then you need to mandatorily report these assets in the T1135 form. There are two sides to this form, which is known as the simplified method, also known as Part A of the form, and a detailed method, which is Part B. So if your value of the assets outside of Canada is more than $100,000, but less than $250,000, you just need to report your assets in a simplified form, which is in a checkbox. So you don't need to report detailed information about your assets, but just detailed checkboxes of the kind of assets that you hold outside of Canada. But if the value of your assets outside of Canada is more than $250,000, then you need to report it in detail in Part B. The Form T1135 is due on the same day as filing your tax return. And if you are eligible to report your foreign assets and have not done, you are subject to penalty of $25 per day of delay, subject to a $2,500 amount.
Yeah. So sorry, just 5 minutes are left.
Yeah.
Okay,
Sure.
so there are
So
questions.
we're
Thank
kind of
you.
done, and we'll quickly.
So everyone, like this is not the very first session we are going to take. We are going to have a multiple session on this, and me and Azhar will be discussing, and like we will be making a complete list of these sessions, and we will try to cover everything in individual text. So this was just a glimpse what Azhar have tried to cover in here. But yes, many things will be done in detail. So just look for it in the group. More details will be shared therein. And thanks for joining in numbers. We will be taking the questions quickly from
Yeah.
here. So there were a lot of questions in the group.
Sure.
So I will start from the first one. First question was, what if only or in family as
Yes,
resident?
because house in Canada, but primary ties go to Canada, so it will be taxable. Coming on quickly to the second question, person files return late, but having a refund position, refund will not be denied, and there will be no penalty for late filing on refund. If only penalty and interest is only applicable if you have a tax payable situation. Is capital gains also applicable? Yes, capital gains is applicable. What about shared properties where one person is Indian, other is Canadian? So you need to report your share value of your share of the property. If it's 50-50, 50% of that portion of the house or property is taxable in Canada. How much are the departure taxes? So departure taxes again is based on the kind of assets you hold. If you're holding investments only in registered accounts, those are not subject to departure taxes. If you departed in less than 5 years, your Indian assets won't be subject to departure taxes, but any other investments or homes that you own would be subject to departure taxes. Would there be capital gain taxability in Canada if the HUF Karta is Indian Canadian? Yes, he would be subject to tax because if the HUF, the Karta is if it's owned under the HUF, in Canada, there is no concept of HUF. So there's a pass-through status. So to the extent the ownership is of the Karta, they would be subject to tax based on his portion of the ownership. Are there any other tax saving avenues apart from RRSP, TFSA? So there is RRSP, TFSA, FHA. So those are tax saving avenues which allow for investments. And apart from that, I think if you purchase a primary residential home and then you sell the house, you are not subject to any capital gains taxes. Thanks, Udit. Yeah, sure. So as Udit discussed it, we would take some sessions coming forward. And tax planning on ratio of salary and dividend. This is going to be, Gaurav, another session we'll take separately. Right now, the purpose of this session was more about basics. So, this is a more detailed, integration concepts and dividend salary, which we'll discuss in a subsequent dedicated session. Yeah. Is RESP room also cumulative? Yes, RESP room is also cumulative. Lifetime contribution room is $50,000. PPT has already been shared. I think Udit and the team will coordinate in circulating the PPT. Federal tax is 15% or 20%. So, so if your salary is 100K per annum, it will be taxed based on the slab rate. So for up to first 55,000, 15%, and the balance 20%. This is only federal, and there'll be provincial as well. So the 20% is not your final liability. will be 20% plus, let's say 10 to 12% of federal. If husband earns 5,000, wife earns 21,000, both are filing, can they get? So in this case, wife will get 15,000 non-refundable credit, and she will also get additional 10,000 of non-refundable credit of the husband, because husband earns only 5,000. So around 10,500 would be transferred. If all the income tax, so there is no concept of joint filing. So each individual has to file their own return, but spousal credits will be allowed to be carried forward. Investment opportunities, I think Udit will be able to answer that coming forward. His spouse is working outside Canada, family based in Canada, will he be tax resident? So each individual's residency is evaluated separately. But in case if the spouse is working outside of Canada and family based in Canada, in that situation, there are certain very case laws which allow for the spouse who is working outside of Canada to be considered to be non-resident, and only the family to be considered to be tax resident. But this is to be evaluated based on case by case basis. You need to see the CRA residency folio, as it has this specific situation in an FAQ format, and you can exactly find the answer there. How much CCA is allowed for personal car expense? Car expense used for business, I think it's allowed at, it's a class 30. I'm thinking it's allowed as 30%. Not on top of my head, but yes, it is around 30% of the like. You may look into the CCA class for claiming CCA for the vehicle that you have purchased. Yeah. So I think, Udit, we have quickly run through all the questions, and we're just about closing.
So thank you as well.